More and more people are turning to the monetary historian of millennia, which is gold, because you don't want to be a holder of debt and you don't want to be a holder of dollars. And this is also a stagflationary environment, which was the seeding ground. Let's just remember Nixon of the Vietnam War fame, that was overspending and bombing to such a huge degree in the military industrial complex, was actually overspending what was spent even in World War II. Many people didn't clock that because it wasn't in Europe, it wasn't making the news, it was some faraway nation which spoke a different language. And that led to, of course, the 1971 going full float and the cessation to have this nasty restricting precious metal tie. And that led to the single biggest gold boom.
Gold prices surged to a new all-time high of $2,586 and are set to extend their gains as the US dollar weakens on Friday. Expectations for a bigger interest rate cut by the Federal Reserve boosted the non-yielding metal, with talks that it could hit the $3,000 milestone. Gold has rallied after reports last week that the U.S. Federal Reserve might be ready to lower rates by 50 basis points next week from the current 5.25% to 5.50%, the highest level since 2001. Francis Hunt provides an in-depth analysis of the current precious metals market, emphasizing that the ongoing surge in gold prices is driven by a global shift away from fiat currencies and a looming debt-based collapse. He believes that as more people become aware of the instability in holding debt or dollars, especially in this stagflationary environment, they are turning to gold. According to Hunt, this marks a significant movement towards tangible assets as the financial system undergoes fundamental changes. The U.S. economic landscape is increasingly setting the stage for precious metals, particularly gold. Recent data shows the greenback remained under pressure after the U.S. Bureau of Labor Statistics reported mixed August PP1 data. At the same time, the number of Americans filing for unemployment benefits rose as expected, exceeding the previous week's figures. Meanwhile, the federal debt has surged to a staggering $35.3 trillion, with an increase of $1.9 trillion in less than a year. This despite years of record tax revenues and economic growth. According to Hunt, all these factors are bullish for gold. He also notes that platinum and palladium are gaining interest, with platinum making notable advances. However, Hunt advises caution when diversifying into these metals, emphasizing a more focused approach. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update.
We are in a debt-based collapse. We are saying goodbye to a fiat and debt-based system in an accelerating environment where the debt deflated immensely from the pandemic events of 2020 through to about 3 or 4 months ago. It was all on the debt side and the dollar was fairly firm. And now we've seen a dollar weakness. So there's two legs and we're having to release this pressure in this debt creation, water tank, this hot water tank. It's almost like a geyser that wants to blow. And this is what happens. And more people are turning to the monetary historian of millennia, which is gold, because you don't want to be a holder of debt and you don't want to be a holder of dollars. And this is also a stagflationary environment, which was the seeding ground. Let's just remember Nixon of the Vietnam War fame, that was overspending and bombing to such a huge degree in the military industrial complex, was actually overspending what was spent even in World War II. Many people didn't clock that because it wasn't in Europe, it wasn't making the news, it was some faraway nation which spoke a different language. And that led to, of course, the 1971 going full float and the cessation to have this nasty restricting precious metal tie. And that led to the single biggest gold boom that took gold to $800 in then dollars terms, which on a CPI adjusted basis, even today, we haven't got close to meeting on their CPI, which I think there's a lot of skepticism around. So, stagflation, 70s, similar take, only a much bigger crash to come. I am probably the biggest bull in the house, and I'm going to keep calling it. And, there's many like me, I think. The economy is doing worse in terms of retail employment. And you'll remember that we weren't in a recession when we met the criteria for a recession in October of last year because of this red hot labor market, which has since seen a lot of downside revisions, and one for the year that was at over 800,000, plus subsequent payroll revisions all the way through. And we're seeing that actually unemployment is doing badly and producer cost inputs are high. And this puts you very much in what I was saying again regarding the 70s and Nixon's era. And I'm not saying it's the same, it's not the same, but it has some of the same elements, and that is stagflation, bad economic growth, stubbornly high prices in a bid. So you have structural inflation for the long run, which will flare up many times. They didn't kill this beast when it was a baby. And the fact that you've just beaten him up for a little bit with rate hikes, he's taken a rest and he's going to come out of that corner swinging again. All of that is good for gold.
In the current global economic environment, it may be prudent to consider investing in gold. As inflation rates rise and economic uncertainties persist, gold is viewed as a secure asset that can offer protection against market volatility. Gold has also become extremely correlated with U.S. stocks on a 12-month basis, with that R coefficient reaching plus 0.897. That's close to the top 1% of all 365-day readings over the past half a century, and it's the most positive connection since mid-May 2011. Hunt highlights that historically, gold has been undervalued compared to equities. He warns that we are on the brink of a globally synchronized debt-based event, which could surpass the economic conditions witnessed in the 1980s. Currently, the gold to Dow Jones ratio stands at 0.062, suggesting that gold remains relatively undervalued. Hunt suggests that, despite being early in this cycle, the current conditions could lead to substantial gains in gold's value relative to equities. Now, let's redirect our attention to a video.
This is the setup that for a while, the 5,000, my apologies, I'm talking a little in the future when I say 5,000, sorry, the $2,530 mark was serving as a degree of short-term resistance. Was a degree of short-term resistance if we have a look at it as a straight line here. And there was, of course, this squeezing along the bottoms. So we had a couple of sell-offs, each time getting bought up higher. And now we've smashed it. And you're watching this on a 4-hourly now, and we're literally at the all-time high, pushing higher. We're about to do 2,560, which means, of course, we're closer to the 2,600. This is on a shortish time frame. We're on the 4-hourly. So we're watching history being made and the rollout. And don't forget, Elijah, on the bigger time frames, we've come on and said the doorstep of 3,000 is one staging post. We've given 6, 8, 7.5, and a number others, all that have come technically out of the bigger time frame charts. But in your question, you were probably asking, many people fear buying a high. You know, it's kind of like, oh, I don't know if I should get in touch with Elijah and his team to make gold purchases. It's clearly at a high. I should be waiting for the dip. And I did prepare a couple of charts along that line that I want to actually show to you. I'm going to take this off a log and explain what I'm showing to you here as well. This is gold, the precious metal, divided by the longest standing index, which is equity index. So we're doing a gold versus equities comparison at the moment, Elijah, against the Dow Jones Industrial Index. And this goes right back to 1897. And so we had, I would argue, a culture of equity slowly being developed that saw the monetary metal be devalued. You almost had a range down like this. And then we got some of those events that I was mentioning when I was referenced Nixon in 1971. And in this chart, I've sort of nipped the top 5% on a red line, which is possibly not a bad place to start taking some profits. There's eventually a point where you can switch some gold into something else. That point is a long way from happening, but there is a point of valuation when everything is too gold dominant. Maybe get property, agricultural land, something else. And here's the super underappreciated, undervalued zone that I put in green. And for those that are thinking and looking at this is a 3-month chart. So each candle is a quarter, and it's a 125-year history. So to get the macro picture, for those thinking, I shouldn't be buying at 2,560, it's an all-time high. The good news is this is one of the biggest cycles I think you're ever going to face. You're going to see a planetary, globally synchronized debt-based event that is going to be so all-encompassing. We've never been so economically connected that could even make the 80s to Dow Jones ratio, look paltry. You could have a move beyond that. And just to give some values to this, the gold divided by the Dow Jones, right now, Elijah, we're at 0.062, that valuation. So that 2,560 divided by the Dow's big number, you're at not even 6%. The spike of the 80s actually was a hard 1. So that's 100%. So, if you think we could be as bad as the 80s or could even go part the way there, there's an immense amount of upside. Just getting to the around the high zone that I've highlighted, where it's typically been a good point to start taking a little bit of profits. You would have to go about 7 times in the benefit of the ratio of gold to benefit gold. So either gold goes up 7 times and the Dow stands still, or the Dow has to sell off a little bit and gold goes up 5 times. Or if the Dow in an inflationary environment, remember, can still inch a little bit forward, gold goes 7 times an already increasing Dow. So these are, this is early doors. People do not have gold in any meaningful manner, the average man, in their portfolios right now. So even thinking now is early doors, get out and do it.
The price of gold has also been buoyed by the dollar's weakness. The greenback has fallen to the lowest level this year against a basket of peer currencies ahead of the anticipated interest rate cuts by the Federal Reserve. It's no surprise to hear that expectations for interest rate cuts by the Federal Reserve were behind gold's latest rally to record highs, as recession worries boost the precious metal's appeal. However, gold may also prove its worth as an all-weather hedge against whatever happens next, even if the central bank makes an unexpected move. Do you believe that gold's recent rally to record highs is sustainable, or do you expect a correction? Share your feedback in the comments below. If you found this video useful, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.